Right now, thick black smoke is rising over the Persian Gulf. Satellite images show a massive industrial complex engulfed in flames. The largest oil processing facility on the face of this earth, Saudi Aramco's Ras Tanura refinery, is burning. 500,000 barrels of oil per day, gone. In a single night, Iran did not just strike a building, it struck the circulatory system of the global economy. And here is what the mainstream narrative is missing. This is not the climax, this is the opening act. What Iran is positioning next in the Strait of Hormuz could send shockwaves through every stock exchange, every gas station, every central bank, and every government on this planet. Stay with me, because by the end of this video, you will understand what happened, why it happened right now, and what comes next. And what comes next changes everything. To understand why Ras Tanura is burning today, you have to rewind just a few weeks. The United States and Israel had been executing what officials described as a calibrated pressure campaign. Precision airstrikes targeted suspected Iranian nuclear facilities. Bunker-buster munitions penetrated hardened underground sites. Guided missiles struck weapons depots linked to regional proxy networks. Simultaneously, sophisticated cyber operations disrupted elements of Iran's command and control infrastructure, temporarily blinding radar systems and interrupting encrypted communications. For years, Tehran had drawn a red line. Cross this boundary, attack our strategic infrastructure, and we will respond in ways you have never imagined. Western analysts largely interpreted those warnings as deterrence rhetoric, strategic messaging, bluff. Then, on a quiet morning before sunrise, Iran called that bluff back. Inside intelligence circles in Riyadh, Dubai, and Washington, assessments had begun to shift. Analysts believed the retaliation window had passed. Weeks had gone by without a major Iranian response. The conclusion: Tehran was calculating, constrained, perhaps unwilling to escalate into full regional conflict. Threat levels were quietly downgraded. Security rotations at several Gulf facilities were adjusted. Maritime patrol patterns became less aggressive. Some drone defense systems were shifted into maintenance cycles. That was the precise moment Iran had been waiting for. The Islamic Revolutionary Guard Corps, the IRGC, had not been inactive during those weeks. It had been patient, methodical. Assets were being pre-positioned with extraordinary discipline. Sleeper networks across Kuwait quietly activated logistics channels. Components moved in small shipments that raised no red flags. In Yemen, drone swarms were assembled through Houthi proxy networks, modular systems designed for saturation attacks. Along Iran's southern coastline, near Bandar Abbas and the mouth of the strait, naval engineers prepared unmanned surface vessels and compact submarine drones capable of hugging the seabed undetected. None of it looked dramatic. Individually, each piece seemed insignificant. But on the night of the strike, it all moved at once. The first target was Ras Tanura, Saudi Aramco's crown jewel on Saudi Arabia's eastern coast. This is not just another refinery. Ras Tanura processes roughly 550,000 barrels of crude oil every single day. It connects directly to the world's largest offshore oil loading platform. Tankers from Japan, South Korea, China, India, and Europe queue offshore, waiting to carry Saudi crude to power factories, airlines, shipping fleets, and power grids across continents. It is one of the most strategically important energy nodes on Earth. Shortly before dawn, radar operators detected unusual signatures approaching from multiple vectors. Low altitude, irregular flight patterns. Seconds later, confirmation, incoming drones, automated defenses activated, interceptor systems launched, electronic jamming signals pulsed outward. But the attack was not linear, it was layered. The first wave triggered defensive systems. The second wave exploited the gaps. A third wave, smaller, faster, slipped through the smoke and electronic noise created by the first two. Explosions rippled across the stabilization units. Secondary blasts followed as pressurized hydrocarbons ignited. Flames surged upward, visible from miles away. Surveillance cameras went dark as power conduits failed. Within minutes, Saudi Aramco suspended all loading operations. Within an hour, crude oil futures in Asian markets spiked $12 per barrel in overnight trading. Insurance firms froze new tanker coverage assessments in the Gulf. By sunrise, energy ministers across Europe were on emergency calls. But what global markets did not yet understand was this: Ras Tanura was not the objective. It was the signal. Because while the world's attention locked onto burning refinery towers, something else was unfolding further east, the Strait of Hormuz. Roughly 20% of the world's oil supply passes through this narrow corridor every single day. At its tightest point, it is only about 21 miles wide. Tankers move through designated shipping lanes that are just 2 miles across in each direction. It is a choke point, geographically fragile, economically indispensable. For decades, Iran has threatened to close it in the event of major conflict. Most analysts dismissed that scenario as self-defeating. Iran relies on the same waters for its own exports, but closure does not require permanence, it only requires fear. Intelligence intercepts now suggest that in the hours after the Ras Tanura strike, fast attack craft linked to IRGC naval units repositioned near key transit routes. Underwater drones, difficult to detect and inexpensive to deploy, began mapping tanker traffic in real time, not to sink dozens of ships, not yet, but to create uncertainty. In global markets, uncertainty is often more powerful than destruction. Within 24 hours of the refinery attack, shipping companies began rerouting vessels. Some tankers slowed their approach, waiting for naval escorts. Freight rates surged. Energy derivatives markets experienced their highest volatility since the early days of the Ukraine conflict. Governments issued carefully worded statements urging de-escalation. But behind closed doors, strategic calculations shifted dramatically. Iran had demonstrated three things at once. First, it could penetrate layered Gulf defenses despite advanced Western systems in the region. Second, it could coordinate proxy networks across multiple countries simultaneously. Third, and most consequentially, it could strike the global energy system without directly attacking U.S. mainland assets. That changes deterrence equations. It reframes escalation thresholds. And it forces policymakers to confront a question they have long avoided. How do you respond to a strategy designed not to win a conventional war, but to destabilize the global economy itself? The smoke over the Persian Gulf is not just industrial fallout. It is strategic messaging. Tehran is signaling that economic warfare can move in both directions. If sanctions choke Iranian exports, Iran can threaten the arteries of global supply. If infrastructure deep inside Iran is vulnerable, then infrastructure deep inside the Gulf is not untouchable either. The next move may not be another refinery. It could be a tanker strike calibrated just below full-scale war. It could be coordinated cyber disruptions targeting maritime logistics software. It could be the temporary mining of a shipping lane, not enough to shut it permanently, but enough to spike insurance premiums to catastrophic levels. Because in modern conflict, sometimes the objective is not territory, it is leverage. So what happens next? Naval deployments will increase, the United States Fifth Fleet will expand patrol corridors, regional missile defenses will shift into higher readiness, diplomatic backchannels will activate urgently. But markets are forward-looking. Investors now have to price in a new reality. The Strait of Hormuz is no longer a theoretical flashpoint. It is an active pressure point. And once a choke point becomes active, every barrel that moves through it carries geopolitical risk. The world may calm the flames at Ras Tanura within days or weeks. But the psychological fire, the realization that the global energy system can be disrupted in a single coordinated night, that fire spreads far beyond Saudi Arabia's coast. The strike was not random. It was timed. It was layered. It was designed to reset assumptions. And if this truly was only the opening move, then the next chapter will not simply be about oil. It will be about whether the global order can withstand a conflict where the battlefield is not defined by borders, but by supply chains. Watch the Strait. Because what happens there next will not just influence energy prices, it will define the balance of power in the Middle East, and possibly far beyond. Iran did not stop at Aramco. While the world's cameras were locked on the inferno at Ras Tanura, a second, far more complex, operation was unfolding across the region. What defense analysts are now calling the most ambitious multi-vector military campaign in the modern history of the Persian Gulf was already in motion. 7 Gulf states, 12 strategic facilities, one single night. This was not retaliation. This was choreography. Bahrain, a direct message to Washington. In Bahrain, sirens shattered the night as ballistic missiles streaked toward the headquarters of the U.S. Navy's Fifth Fleet. The Fifth Fleet is not symbolic. It is the operational backbone of American naval power in the Middle East. From its base in Manama, it oversees maritime security across nearly 3 million square miles of ocean, including the Strait of Hormuz, the Arabian Sea, and large portions of the Indian Ocean. It escorts oil tankers. It counters piracy. It projects deterrence. Striking that headquarters was not a proxy action. It was a direct confrontation between Iran and the United States. Air defense systems activated within seconds. Interceptors launched. Radar arrays tracked multiple trajectories simultaneously. Most incoming missiles were neutralized before impact. But interception is not immunity. Debris fell. Shockwaves rippled. Operations were briefly disrupted. And the message from Tehran was unmistakable. We can reach the command center of your regional power. For Washington, that changes the calculus. For regional allies, it alters assumptions about American protective guarantees. Qatar. Energy shockwaves. Across continents. Simultaneously, in Qatar, Iranian drones targeted Ras Laffan, the world's largest single liquefied natural gas export facility. Ras Laffan is not just another terminal. It is the epicenter of global LNG trade. Qatar supplies roughly 20% of the world's liquefied natural gas. That LNG heats homes in winter across Europe, powers heavy industry in Asia, and stabilizes electricity grids from South Asia to Latin America. When warning systems detected inbound drones, emergency protocols initiated an immediate shutdown of loading operations. Pipelines depressurized, tanker berths halted. Export schedules froze. Within minutes, energy markets reacted. European natural gas futures did not simply tick upward, they surged, up 45% in a single trading session. Traders described the move as panic pricing. Germany convened an emergency cabinet session before markets even closed. Energy ministers across the European Union scrambled to calculate reserve levels and worst-case winter scenarios. For countries already balancing fragile energy security, the message was chilling. The Gulf is no longer a stable supply corridor. The UAE, psychological warfare in the financial capital. In the United Arab Emirates, the skyline of Dubai, normally illuminated by luxury towers and architectural spectacle, was streaked with interceptor missile trails cutting through the darkness. Iranian drones penetrated deep into Emirati airspace, reaching areas as far as Palm Jumeirah. The UAE activated advanced defense systems, including THAAD and Patriot batteries. The vast majority of incoming threats were intercepted before reaching high-value targets. But physical damage was not the primary objective. Psychological damage was. Dubai is not simply a city. It is the financial nerve center of the Arab world. It is where sovereign wealth funds operate, where multinational corporations establish regional headquarters, where global investors park capital for exposure to Gulf growth. When footage emerged of smoke rising near the iconic Burj Al Arab, markets responded instantly. Capital flight from Gulf equity exchanges accelerated. Insurance premiums for regional infrastructure spiked. Currency hedging activity surged. Even if damage was limited, perception was transformed. And in financial systems, perception moves faster than fire. Cyprus, the European threshold crossed. Then came the escalation few predicted. In Cyprus, Iranian drones struck the British Royal Air Force Base at Akrotiri. RAF Akrotiri is sovereign British territory. It serves as a key logistical and operational hub for Western military operations in the Middle East. From there, aircraft conduct surveillance missions, humanitarian operations, and strategic deployments. This marked the first time in modern history that Iran launched a direct kinetic strike on a NATO-linked installation located in Europe. The implications reverberated immediately through Brussels and London. An attack on a NATO-associated facility raises profound alliance questions. Does it trigger collective response mechanisms? Does it demand escalation? Or does it remain confined to regional retaliation dynamics? The ambiguity was strategic. By striking Akrotiri, Tehran expanded the geographic footprint of confrontation, signaling that escalation would not remain neatly contained within Gulf waters. The deeper objective, rendering Hormuz unusable. Now here is the part most analysts are only beginning to grasp. The drone and missile strikes, devastating as they were not isolated objectives. They were preparatory maneuvers. Their deeper strategic purpose was to transform the Strait of Hormuz from a stable trade corridor into a zone of persistent uncertainty. Roughly 1/5 of global oil supply transits that narrow passage every day. At its narrowest point, shipping lanes are only a few miles wide. Tankers move in carefully regulated corridors, heavily insured and tightly scheduled. For decades, Iran has threatened to close Hormuz outright in response to severe provocation. Most global energy analysts dismiss such a move as economically self-destructive for Tehran, but closure is not required. Functional paralysis can be achieved through risk. By striking infrastructure across multiple Gulf states in one synchronized operation, Iran demonstrated reach, coordination, and unpredictability. Shipping companies now face a different calculation. If drone strikes can reach Ras Tanura, if ballistic missiles can target Bahrain, if LNG terminals in Qatar are vulnerable, then what guarantees the safety of a tanker transiting Hormuz tomorrow morning? Insurance firms began recalculating maritime risk premiums almost immediately. Some carriers delayed departures. Others demanded naval escort guarantees before entering the Gulf. Freight rates surged. Oil futures spiked again. The strait did not need to be physically blocked. It simply needed to feel unsafe. And once doubt enters a supply chain that moves billions of dollars per day, the system slows, sometimes dramatically. Strategic signaling, layered and deliberate. This was not chaos. It was layered signaling. To Washington, your command nodes are within range. To Gulf monarchies, your economic lifelines are vulnerable. To Europe, your energy diversification strategies are fragile. To global markets, stability in the Gulf can no longer be assumed. Iran executed a synchronized display of capability across air, sea, and cyber domains. Without launching a full-scale invasion, without deploying conventional ground forces, without formally declaring war. That ambiguity is intentional, because ambiguity complicates response. The energy economist's nightmare. Here is what keeps energy economists awake at night. Modern energy markets are built on predictability. Futures contracts, hedging instruments, and long-term supply agreements all rely on the assumption that choke points like Hormuz remain navigable. If that assumption erodes, even temporarily, price volatility becomes structural rather than episodic. Imagine oil sustaining double-digit daily swings. Imagine LNG supply interruptions during peak winter demand. Imagine developing economies forced to choose between energy imports and fiscal stability. This is not merely a military confrontation. It is an economic stress test of globalization itself. What comes next? Naval deployments will intensify. Surveillance will expand. Diplomatic backchannels will attempt de-escalation. But something fundamental has shifted. For decades, the Gulf operated under a fragile but consistent principle: deterrence through overwhelming Western naval presence. That principle has now been challenged, not destroyed, but challenged. And in geopolitics, once a perception of invulnerability cracks, it rarely returns unchanged. Iran did not need to win a conventional war in a single night. It needed to prove that it could impose cost. It needed to demonstrate that retaliation could be multidimensional. It needed to show that the Strait of Hormuz is not merely a geographic choke point, but a strategic lever. The fires at Ras Tanura may eventually be extinguished. Runways at Akrotiri will be repaired. Defense systems in Bahrain, Qatar, and the UAE will recalibrate. But the question now echoing through global markets is far larger. If this was phase 1, what does phase 2 look like? And more importantly, who is prepared for it? The Strait of Hormuz is not just another shipping lane on a map. It is the most critical energy artery in modern history. At its narrowest point, it is just 17 miles wide. 17 miles. Through that narrow corridor flows roughly 20% of all globally traded oil every single day. Between 15 and 17 massive crude tankers pass through it every 24 hours, each one carrying millions of barrels of energy that power cars in California, factories in Germany, cargo ships in Singapore, and power plants in India. Entire national economies depend on those ships arriving on time. Iran has always understood a simple truth. It cannot outmatch the United States in a conventional head-to-head military confrontation. It does not possess the carrier strike groups. It does not command the same satellite architecture. It does not have the global logistics network. But it does not need to defeat the U.S. Navy in open battle. It only needs to make the strait so dangerous, so legally complicated, so financially radioactive, that shipping companies, insurers, and tanker captains decide on their own that entering it is not worth the risk. That is exactly what has now happened. The announcement that changed everything. Within hours of the coordinated Gulf strikes, the Islamic Revolutionary Guard Corps issued a carefully worded statement. It announced it was conducting what it described as security operations in the Strait and the Gulf of Oman. That phrasing was deliberate. Not blockade, not closure, not war. Security operations. But in maritime law and commercial shipping, wording matters less than risk. Soon after the announcement, Iranian fast attack boats began shadowing commercial vessels in international waters. They did not fire. They did not board. They simply followed, sometimes within visible range, sending an unmistakable signal: we are watching every hull that enters. For tanker captains, this was a psychological escalation. A 300-meter oil tanker, heavy with cargo, cannot maneuver quickly. It cannot outrun smaller, faster craft. Its vulnerability is inherent. Then came the decisive blow. Not from missiles, not from drones, but from the insurance industry, when insurance says no. The world's major maritime reinsurers, including Guard, Scold, North Standard, and the London P&I Club, issued 72-hour war risk cancellation notices, covering vessels operating in the Persian Gulf, the Gulf of Oman, and Iranian territorial waters. This was not procedural fine print. This was the global insurance market stating plainly, if you sail into this zone, you may not be covered. No coverage means no protection against damage, seizure, or loss. No coverage means banks may refuse to finance cargo. No coverage means shipping companies assume potentially catastrophic liability. In the modern global economy, insurance is oxygen. Without it, trade suffocates. The effect was immediate. More than 150 oil tankers, collectively carrying billions of dollars in cargo, dropped anchor outside the strait. Crews waited for clarity. Executives waited for guidance. Governments waited for signals. And the strait, while technically open, became functionally paralyzed. Iran did not need to sink ships. It needed to make sailing too risky. Markets react. Fast and brutal energy. Markets responded within minutes. Tanker freight rates surged to the highest levels ever recorded. Charter costs doubled, then tripled, as ship owners demanded extraordinary compensation for entering the risk zone. The spot price of crude oil breached $95 per barrel in early trading, and kept climbing. Analysts at Goldman Sachs issued an emergency note revising their 60-day oil forecast upward to between $100 and $120 per barrel if the strait remained effectively closed. That projection sent a chill through policymakers. Because every $10 increase in crude oil typically adds roughly 25 cents to the price of a gallon of gasoline in the United States alone. Now multiply that impact across airlines already operating on tight margins, across trucking companies moving food and goods, across manufacturers dependent on petrochemicals, across farmers running diesel equipment, across plastics producers, construction firms, and shipping conglomerates. The ripple effect becomes exponential. The International Monetary Fund issued an emergency statement warning of severe and potentially cascading risks to the global economic outlook. That language is rare. When the IMF speaks in those terms, it signals systemic concern. Asia feels. At first, markets do not tolerate uncertainty, and Asian exchanges were the first to open after the news broke. The Nikkei 225 fell sharply. The Hang Seng Index slid hard. The Kospi dropped in tandem. All three economies are critically dependent on Gulf energy. Japan imports approximately 90% of its crude oil. South Korea imports more than 80%. China, the world's largest oil importer, sources around 40% of its crude directly from Gulf producers. When the strait trembles, East Asia feels it immediately. Factories anticipate higher input costs. Airlines project fuel surcharges. Investors price in slower growth. By the time European markets opened, selling accelerated. Germany's DAX fell 4%. London's FTSE dropped over 3%. Airline stocks were among the hardest hit globally. Energy-intensive industries, chemicals, heavy manufacturing, transportation, led the declines. Wall Street and the safe haven stampede. On Wall Street, the S&P 500 slid more than 2% in the first hour of trading. Defense contractors surged. Energy majors spiked. Airlines tumbled. Gold hit its highest level in 18 months as investors fled toward perceived safety. But the bond market sent the clearest message. Investors poured money into U.S. Treasuries, a classic panic safe haven trade, driving yields downward. At the same time, sovereign bond spreads for Gulf states widened dramatically. In plain language, that means investors were demanding higher returns to hold Gulf government debt. The market was pricing in genuine risk, not just to energy flows, but to political and financial stability in some of the world's wealthiest states. This is how economic shockwaves spread, not through explosions, but through spreadsheets. The strategic masterstroke. Iran's strategy was never about total closure. It was about transformation, transforming the strait from a predictable shipping corridor into a high-risk environment, transforming insurance from a background administrative detail into a front-page headline, transforming oil from a commodity into a geopolitical weapon once again. For decades, the global economy operated on an assumption. Whatever tensions flared in the Middle East, the Strait of Hormuz would remain open. That assumption has now been cracked. And once a core assumption of global trade breaks, rebuilding confidence is far harder than breaking it. The broader implications. If the paralysis continues even for weeks, strategic petroleum reserves will begin to draw down. Governments will consider rationing scenarios. Central banks will confront inflation spikes just as many economies are attempting to stabilize post-pandemic growth. Emerging markets, especially those dependent on energy imports, face currency pressure and fiscal strain. For Gulf states themselves, the paradox is acute. Higher oil prices increase revenue, but instability threatens long-term investment, tourism, and financial inflows. This is not a local crisis. It is a systemic stress test. The Strait of Hormuz remains physically open. No official blockade has been declared. No permanent barriers installed, and yet over 150 tankers sit motionless. That is the power of strategic ambiguity. Iran did not need to defeat a navy. It needed to frighten an industry. And in a globalized economy where confidence drives commerce, fear can be more disruptive than firepower. The question now is not whether the strait can be reopened. The question is whether confidence can be restored before economic shock turns into global recession. Because if uncertainty becomes the new normal, this crisis will not remain confined to the Middle East. It will reach every fuel pump, every grocery store, every airline ticket, and every household budget on Earth. So where does this go from here? Right now, in defense ministries, intelligence briefings, and central bank war rooms across the world, analysts are modeling three core scenarios. The distance between them is not minor. It is the distance between a painful but manageable global shock and something far darker. Scenario 1, diplomacy moves faster than escalation. In the first scenario, diplomacy outruns destruction. Regional intermediaries like Qatar and Oman quietly activate back-channel communications. Both countries have historically maintained lines of dialogue with Tehran, while preserving working relationships with Washington and Gulf monarchies. They are uniquely positioned to talk when others cannot. In this pathway, the United States signals, privately, a willingness to pause further direct strikes on Iran's nuclear infrastructure. In exchange, Iran withdraws its fast attack boats from aggressive shadowing patterns and scales down so-called security operations in the Strait of Hormuz. Insurance firms reinstate coverage, first cautiously, then more broadly. Tankers resume transit under naval escort. Oil prices remain elevated but stabilize. Markets recover part of their losses. Governments declare de-escalation a success. It would not feel like victory to anyone, but it would prevent catastrophe. This scenario depends on timing. The longer uncertainty persists, the harder it becomes politically for leaders to compromise without appearing weak. Every passing day of high oil prices increases domestic pressure in energy-importing nations. Diplomacy is most effective before anger hardens into policy. Scenario 2. Calibrated force, controlled shock. The second scenario assumes that deterrence must be reasserted physically. In this pathway, U.S. Navy carrier strike groups reposition visibly in and around the Gulf. Surveillance aircraft increase patrol frequencies. Submarines quietly move into forward operating zones. The message to Tehran would be unmistakable. Any physical mining or declared blockade of Hormuz will be met with overwhelming naval response. Simultaneously, Gulf states such as Saudi Arabia and United Arab Emirates could authorize precision strikes against select IRGC-linked assets inside Iranian territory. Radar sites, drone depots, command facilities. Not regime change, not invasion, but calibrated punishment. Iran, having demonstrated its capacity to disrupt markets, might calculate that it has already achieved strategic signaling. It could pull back from direct confrontation while maintaining rhetorical defiance. In this scenario, oil remains expensive. Insurance premiums stay elevated. The global economy absorbs the shock through higher energy costs and slower growth. Painful, costly, but structurally survivable. This pathway hinges on mutual restraint, force used not to escalate, but to cap escalation. History shows that such balance is difficult, but not impossible. Scenario 3. Formal blockade, structural shift. Then there's the third scenario, the one that keeps generals, economists, and heads of state staring at ceilings at 3 a.m. Iran does not blink. Instead, emboldened by having struck European-linked territory, by having demonstrated vulnerability around the U.S., Fifth Fleet, and by having moved global markets more dramatically in 12 hours than almost any single actor in modern history, Tehran formally declares a blockade of the Strait. It deploys its full unmanned submarine fleet. It threatens to mine the narrowest transit corridors. Fast attack craft establish persistent presence near shipping lanes. Even without sinking vessels, the announcement alone could freeze maritime trade. At that point, global reaction becomes unpredictable. China, whose economy depends heavily on Gulf energy imports, faces a strategic decision. Does it pressure Tehran to step back? Does it negotiate independently to secure its own supply corridors? Or does it leverage the crisis to expand its diplomatic footprint in the region? Russia, already largely cut off from Western energy markets, might see opportunity. With Gulf exports constrained, Moscow's leverage over European supply chains could tighten further. What began as retaliation for strikes on Iran's nuclear infrastructure would evolve into something much larger, a restructuring of energy flows, trade alignments, and geopolitical dependencies across continents. Not a regional conflict, a systemic one, and systemic shifts, once set in motion, are rarely reversible. The battlefield. You cannot see. Here is the revelation that makes this entire chain of events coherent. Iran did not launch these strikes because it believed it could win a direct military confrontation with the United States or Israel. It launched them because it has concluded, after decades of sanctions, observation, and asymmetric strategy, that the true battlefield is economic. The battlefield is the price of oil. The battlefield is the yield on a government bond. The battlefield is inflation data released on a Thursday morning. The battlefield is whether ordinary families in Western democracies continue to support assertive foreign policy when filling their cars costs $70 or $80 per week. Military power shapes territory. Economic pressure shapes political will. Iran's calculation appears to be this: if it can raise the economic cost of containment high enough, persistently enough, domestic pressure inside energy importing nations will eventually alter policy trajectories, not through invasion, not through occupation, but through exhaustion. Why oil above $100 changes politics? If crude sustains levels above $100 per barrel for 6 months, inflation, which many central banks have struggled to contain, could reaccelerate. Interest rate cuts could be delayed. Consumer confidence could weaken sharply. Stock markets could remain suppressed. Recession fears could return. Governments facing elections would confront voter anger not over distant strategy, but over daily expenses. Energy is uniquely political because it is universal. Every household feels it. Every business calculates it. Every supply chain embeds it. If economic strain becomes persistent, policymakers may face a dilemma: sustain aggressive regional posture at high domestic cost, or recalibrate strategy. From Tehran's perspective, that is leverage. The strategic endgame Iran is not necessarily seeking permanent closure of Hormuz. That would harm its own export capacity and risk overwhelming military retaliation. It is seeking to prove capability, to prove that it can destabilize the global system at will, to prove that containment carries price. Once that proof exists, every negotiation changes, every sanction discussion shifts, every military planning session factors in economic blowback. That is asymmetric warfare at the highest level, not about destroying cities, but about influencing calculus, the fire and the future. The fire above Ras Tanura still burns in satellite imagery, but the greater fire is abstract. Volatility in markets, fear in boardrooms, uncertainty in government corridors. The question now is not merely whether flames at a refinery will be extinguished. It is whether confidence, once shaken, can be restored. Will diplomacy outrun escalation? Will calibrated force reestablish deterrence? Or will a formal blockade push the global order into a new and unstable phase? Historians often identify turning points only in hindsight, weeks, months, years later. But sometimes, even in the present, there is a sense, quiet, uneasy, that a threshold has been crossed. If energy flows stabilize and diplomacy prevails, this week will be remembered as a crisis narrowly contained. If not, it may be remembered as the opening chapter of a restructuring of global power in the 21st century. The smoke over the Gulf is visible. The strategic consequences are still forming, and the world now waits to see which of these three futures becomes reality.